Good afternoon, everybody. Welcome to the Clean Energy Regulators Quarterly Carbon Market Report, September quarter 2020 webinar. We are very excited to run this, our first little webinar, to dive into some of the data and the components of the report. So thanks very much for joining us. If you don't know me, my name's Cameron Matthew. I'm the manager of our economic analysis section who produced the report. We're very focused on carbon markets and how they're performing and what they're doing, and very happy to share with you what we've found out over the last quarter. If you have any questions, I'm very happy to deal with them as we go through the presentation. There's a few moments where I'll kind of pause for questions, and for those of you new to the Teams live experience, there's a Q&A component there. You can post your questions there. I've got my colleagues Shakir and Jess looking through those and posting them up, but also trying to answer them as we go. So feel free to write questions in there as you would like. We'll jump in a second, but before we do that, look, a few little things to cover. I'd just like to flag, just if you didn't know, the Clean Energy Regulator is not a financial advisor. When it comes to Australian carbon credit units, they are a financial product. And the information that I'm giving you here is for general information only, and it's important to note that if you need advice on ACCUs, you need to seek an AFSL licence holder, and you need to seek the right advice from the right people. I'd also like to acknowledge the traditional owners of the many lands on which we gather today, and acknowledge their continuing connection to land, sea and culture. We pay our respects to their elders past and present and emerging, and extend those respects to any Aboriginal and Torres Strait Islander people that are joining us today. For those of you from Canberra, where we're broadcasting, this is located on Ngunnawal and Ngambri country, where the traditional owners have been living and caring for the country for the last 20 years. Now, continuing into our presentation, I'll take us through the various markets, kind of market by market, ACCUs, LGCs, STCs. I'll also be covering off voluntary carbon markets and the feature in the report this quarter, which was on some of our outlooks for rooftop solar over the next kind of 4 to 5 years. Let's jump in. So ACCU and ERF markets. It was an interesting quarter for ACCU and ERF markets. The ERF supply increased by 2.5 million in the quarter to reach 10.9 million for the year. A little bit down on the comparative period last quarter 3. However, this is just a bit of kind of bumpiness in the crediting behaviour. We've already credited more than 1 million in the first few weeks of October, and 2.9 million over that month. So we're actually tracking very well to an expected 16 million ACCUs to be created this year. If you can see there, the balance of ACCUs actually fell a little bit, so it's only down from above 7 to about 6.5 in accounts. We expect that to probably rise quite substantially in quarter 4 as estimated supply comes in above estimated demand for the ACCU market. The big story for the ACCU markets this quarter was definitely the surge in registrations. We saw something in the order of our best quarter for a number of years now, since quarter 2 in 2018, and so we saw 44 projects registered, quite a lot in the vegetation space, but also, as the report covers, a substantial surge in soil carbon projects, which have now come on strong for the 3rd quarter running, and you see that through the kind of agriculture, the light blue bar in this chart. Again, 2020 is shaping up to be a very large year for project registrations, and a really exciting one. And we had, for example, 50 soil carbon projects on hand, applications on hand, that'll probably mostly get processed in quarter 4. As far as soil carbon goes, there is now new upfront support for soil sampling, and that's in the frame to actually bring on quite a lot more projects early on to assist in the costs of actually undertaking sampling at the start of projects. The other major thing that happened in the quarter for the ACCU market was auction 11, which was a pretty successful auction from our perspective, with close to 7 million tonnes being contracted to be delivered over future years. Prices remained relatively similar to auction 10, a little bit lower, sitting just below $16 as the average price paid per tonne of abatement at the auction. But again, substantial volume and returning to volumes we saw in auctions 5, 6 and 7. The other thing to note out of the auction was that the bulk of participants sought the optional delivery contract as opposed to the fixed delivery contract. And in fact, 6.3 million tonnes of the abatement went towards that style of contract, with only a small number selecting the older traditional fixed. This chart here that you've got on your screen here gives you a bit of a feel for how that abatement is spread out over the years, and you can see the forward profile of deliveries under the Emissions Reduction Fund, the forward contracting, with the bulk of that 7 million tonnes kind of coming in the second half of the 2020s, in particular, and kind of 2027 onwards, where we're seeing most of that abatement being expected to be delivered. Going on to spot prices with ACCUs, it was very flat for the first part of quarter 3, and in fact not much activity until September, where we also saw transaction volumes in our registry increase quite substantially as well. So after a kind of quiet period, we've seen a number of activity, and spot prices are now kind of back above $16, which is above the auction price. It might be worth pausing there. We've got a few questions already coming through that I can tackle for the ACCU market before we move on to the other markets. The first question, and thank you for those who've posted, and feel free to post, and you'll note there's a few people that have posted anonymously. You can do that if you don't want to be attributed, and we're quite happy to do that. Or if you want to, put your name down and tell everybody who you are and why you're asking your question. So the question about the steep jump, Shakir's had a go at answering that. What we've seen, and I might just track back to that slide so people can see, is that quarter 2 next year has quite a large scheduled demand. Now, this just reflects how people have started structuring their contracts, and what we will see is quite a lot of early deliveries on that demand in quarter 2, 2021. This is just before the end of the financial year, when people have started to structure their contracts to schedule then, but we should expect quite a lot of early delivery on those. And if you look at the current surplus in the market of 6.5 million, we should expect a lot of those contracts to be delivered on early, and that's totally fine as far as the contractual terms are considered. Right. I'll see if there's any other questions. Richard's asked a question. Are the ACCU spot prices trade weighted? Richard, I don't think so. I think there's not a lot of trades. They're very infrequent, and so what you'll probably see there is the value of the trade at the point in time. So there's only a small number of trades every month. Okay, we might move on to ACCUs now. And sorry, LGCs now. So LGCs has been in a very interesting market over the last little while. We're coming up now only a few months out from the surrender deadline for LGCs, the 14th of February. So a lot of participants are trying to sort out their position for the year and what strategies they're going to take to meet their compliance obligations. The markets are quite tight this year. If we look at this table here, which we publish, it tries to give you an expectation for how many LGCs are actually available in the market to be used against the target. So last year, at the point of surrender, there was 7.4 million LGCs in surplus sitting in accounts, and we're forecasting 32 million LGCs to be supplied for the 2020 surrender year. So that means that they have to actually be created and also validated before the 14th of February to be available for use for the 2020 compliance year. We have a legislated demand component of about 33.6. Now that's come down 100,000 LGCs from I think what we published last quarter, and that's because of some liable entities seeking to reduce their demand for the year due to lower than expected electricity demand. As you would have noted, for some entities, COVID has reduced overall electricity sales, particularly in the small business sector. So legislative demand is down a little bit from where we expected in terms of the number of certificates. There's a number of shortfall charge refunds we expect to come in this year at 1.1 million. That's shortfall taken in previous years, which we think will come in as at or just before the 14th of Feb. And a few things we'll touch on in a little bit more detail. The three last rows in this, the ACT government green power and other voluntary surrenders have been going very strong, and in fact that's one of the main reasons why the market is quite tight, with nearly 4 million in surrenders expected by the end of the year. And this means that in effect, if no one was to take a shortfall position this year in the LGC market, we'd only have about 800,000 LGCs spare in accounts. But obviously, as we know each year, liable entities are looking at their position now, and our expectation is that there'll be a substantial amount of shortfall again this year, like there was last year, given the position in terms of the available number of LGCs. Looking at price, this kind of feeds through into the price story, and certainly, although prices have come down in the quarter, they did spike quite heavily towards the end of September, and they're now back kind of at the kind of $38–40 range, and certainly in out year forwards, prices have risen and have kind of now stabilised. So that's kind of indicating that the market's sorting out what kind of position and what kind of shortfall people are planning to take this year. But it is interesting to note that all of the forwards are well up on where they were earlier in the year. And this is part of the story about what's going on in the LGC supply story, and in terms of generation overall. One of the things that we've released in this quarterly market report is actually kind of our expectations and tracking to the 2020 target. Now, we still think the most likely outcome is going to be about 33 terawatt hours, which is kind of bang on the target, but there's been a lot of, I suppose, what you'd call kind of lowerings of expectation throughout the year, and certainly a number of commentators have seen this. In some respects, the wind resource has been a bit lower than in previous years, particularly in June and July of this year, where we saw quite kind of subdued amounts of wind generation. There's a number of stories around the kind of slower than expected commissioning, and higher amounts of curtailment than ever before, in effect because there's so many renewable power stations trying to connect, and grid operators trying to figure out how they can fit them all in and make them work. So at the start of the year, we expected roughly 35 terawatt hours, or 35,000 gigawatt hours, and we've actually downgraded that to 33. And there are a number of potential downsides still apparent in terms of we're still trying to connect these power stations, and there's still a lot of potential for grid stability and economic curtailment to occur in Q4. So watch this space, and the upcoming quarterly market report, which we'll release in February. We'll look to see how we tracked against the target for 2020. One of the really exciting things, though, in looking forward a bit further, we had a fantastic Q3 in terms of firmly committed capacity, tracking it over a gigawatt for the quarter, and bringing the moving average actually up above where we were in mid-2019, and that Q3 result is actually comparable to some of those fantastic quarters we saw in 2017 and 2018. And since the end of the quarter, in Q4, we're already tracking 500 megawatts of firmly committed capacity, which means that we've already exceeded what was committed in 2019. So in fact, investment in large-scale power stations is looking a little bit up on 2019, which is a really great result to see. I might pause there again and see if we've got a few more questions to tackle. Let's see what we've got. So I've got a question there from Shal on price information. Thanks, Shakir, who's kind of flagged that price information is reported price information from brokers and traders. Again, we do publish in our quarterly carbon markets report our estimation of total movements across all trades, and probably roughly a third are reported broker or publicly reported trades, and probably 2/3 are kind of over the counter and not visible apart from the information that we provide in the QCMR. Let's see if there's any other questions before we go on. Looks like there aren't, but please ask them as we go. I'm happy to go into the detail of the data and what it's saying. All right, we might flick now onto the STC market. So probably the big story in the STC market for this quarter was obviously the shutdown in Victoria, and that certainly pulled back quite a lot of installations, particularly in the metropolitan Melbourne region. And I think we're down about 20% on where we were across the quarter, and about 40% in Metro Melbourne. So it's quite a substantial contraction. Obviously, for 2 of the 3 months of the quarter, pretty much the bulk of residential installs were prohibited. And you can see that in the data in front of us here, just tracking to that. You can see the dip in Victoria, but quite fantastically, all of the other states grew in comparison, and grew quite substantially, particularly New South Wales, more than compensating for that dip in Victoria, which has actually kept us on track for roughly 2.9 gigawatts installed for the year, which is a fantastic kind of result. And in fact, what we're seeing now, and I'm sure what the industry is talking about in Victoria, is quite a solid rebound in Q4. So we could see quite solid results from Victoria, maybe making up at least part of that dip that you see there in Q3. So it'll be interesting to see how far that takes us. But early results in October and November are promising for Victoria. So we are seeing growth across the board. That's a pretty consistent story for a very long time in the small scale scheme. And of course, in regards to STCs and where they're up to, we are still forecasting quite a substantial surplus available after the Q4 surrender. And you can see that surplus growing each quarter. And because Q4 only represents about 15% of the total liability for each year to be surrendered in Q4, we expect the surplus to be around about 12 million STCs to be carried over into next year. And we're in the process of determining the STP, and that'll be announced early next year. But those surplus amounts will be considered in that component. So a very solid result in terms of prices for STCs. They have hovered in the $38 range for quite a while, so it's been very stable for STCs. Pause there on questions for the small scale scheme, see if anybody's got anything to ask. So Richard's asked about ACCUs and LGCs. I've had this question a couple of times now. ACCUs and LGCs being interchangeable, and it is important to note that both ACCUs and LGCs can be used right now, in particular under the Climate Active scheme, for different types of emissions. So LGCs for Scope 2 and ACCUs for any type of emission as an offset. International carbon units as well can be used under that scheme. So Richard, it would be worth checking out the King review, which was released earlier this year. The King review talks about the potential for a type of exchange or calculation to work out the equivalence of these two units and how that might be done. And that's one of the recommendations that I believe is being worked on. So check out the King review and the government's response to the King review there. That certainly would go further to kind of talk about a kind of genuine exchange between those two units, but they do represent different things. LGCs represent a megawatt hour of renewable electricity, and an ACCU represents a tonne of carbon equivalent either avoided or removed from the atmosphere. So so they are measuring different things, but certainly we'll get to it in a second. They are being used in greater volumes and somewhat interchangeably, you could argue, to meet various corporate climate goals. But a good question, and please keep asking it and watch this space, because I think there will be more to come on how LGCs and ACCUs interact. Certainly in the past, we've talked about, you know, the rough equivalence of those two LGCs coming down in price, kind of in 2022, 2023, having a rough equivalence in terms of their carbon value, and that's when it becomes interesting about, well, do LGCs then see a floor price emerge as they become equivalent to an effective ACCU? But again, watch this space as there's a bit more development work on the way, I think. Okay. We'll just keep pushing on then. As I said, keep throwing your questions in. There's some very good questions so far, so I appreciate those. And any feedback about things you might want to hear about in the quarterly carbon markets report, that'd be very, very useful to hear some more about that as well. All right, let's plug on and get to the really interesting stuff and what's been happening in the voluntary market. So I kind of alluded a little bit to it in the LGC component of this presentation, but if you look here, it's been a kind of crazy result in relation to the number of LGCs surrendered, but it's also a very good result from an ACCU perspective. This chart here, we've had to break the graph because the LGC surrenders are just so high. Now, every Q3, we always get green power surrenders, and green power surrenders are roughly equivalent, ever so slightly up, roughly 500,000 this year, which is a promising result. Green power's been coming down over the last couple of years, and it's now kind of stabilised, maybe starting to go up a little bit, so it might signal a bit more interest in the green power scheme. But we've seen a very large result from a number of desalination plants who've chosen to surrender LGCs this time around, to kind of ensure that the power they're using and their emissions are kind of carbon neutral. A number of other entities that have surrendered LGCs, and quite a lot of climate active participants. So for those who are familiar with the Climate Active scheme, this is run by the Department of Industry and provides certification that products and businesses are carbon neutral. So that's a promising result, and in fact there's quite a substantial number of surrenders under the Climate Active scheme for ACCUs as well. And then on top of that, we've got the ACT government that's surrendered over 2.3 million certificates, and those certificates have been accumulating in accounts for a couple of years now, and they're a result of the accumulation through the ACT's reverse auction processes for their 100% renewable scheme. So they came in Q3, and we should expect that to happen each Q3, roughly from now onwards, depending on the ACT's amount of renewable power it needs to meet its stated targets. But the real upshot here is that the voluntary markets that we've been talking about for a while taking off have started to take off, which is really exciting to see. And it's driven across a broad number of components, not just one. And going back to Richard's question before, there is a bit of a trade-off there where climate active entities, desalination entities, may choose to use ACCUs and LGCs depending on what suits their purposes and what they might have available to them. So very exciting to see there that that voluntary markets have really taken off. looking at the 2019, so the other thing we published in this quarterly report is a bit of a backwards look at the voluntary market in particular and what the breakdown of units was for 2019. It takes a while for all of this data to come in, both through our industry and the Climate Active team as well helps us out to try and break this down. So just to give you a feel for the voluntary market in comparison to LGC and ACCU markets, I've kept the STC market out of this because they're not typically used other than to meet the annual STP, the annual target. It's roughly 16% of the carbon market now, which is exciting. It's grown from 12% to 16% when we compare it to 2018. And in fact, there's been slow but noticeable shifts both in the use of less certified emissions reduction units as a proportion. So these are those under the Clean Development Mechanism. There's less CERs as a percentage, more verified carbon units and verified emissions reduction units, so they're international voluntary certification schemes, and also slight upticks, I think, from roughly about 1% to about 1.2% and 1% to 1.3% for LGCs and ACCUs. So that's encouraging to see that domestic units continue to gain market share in the voluntary space. And obviously with the numbers I just showed you for 2020, that will grow substantially again. So we are seeing more and more interest in domestic units, particularly as they probably become a bit more cost competitive, and probably a little bit less use of the CER units. To add to that, this quarterly report, we try to give a bit of a breakdown where those 2019 international units came from. And this does jump around from year to year. This first year we've published this. This year we saw quite a lot of wind projects in India, generating quite a lot of the international offsets that are being used here, both through the Climate Active scheme and for other purposes, and a bit of landfill gas from Malaysia, and a few other bits and pieces from various predominantly Asian countries. So it's interesting to just kind of see where these international carbon units are coming from. And this is just interesting to track where they come from in previous years. They've come more from say China or Brazil, and this year it appears that India has been kind of highly represented in access to those carbon units. All right, I might pause there again for questions because there's pretty interesting things in amongst that, and see if anybody's got anything to say. So Luke from Landcare obviously asked about state and territory demand dropping in the quarter for ACCUs. Is there a cyclical nature? So state and territories haven't made up a lot of ACCU demand to date, certainly been more in the LGC space. Yes, it is somewhat cyclical, and quite often, depending on when they choose to surrender, it's a bit patchy from quarter to quarter. So I wouldn't read too much into a quarter by quarter drop. Just going back and looking at the data there. So in Q3 last year, we saw a little bit of state and territory use of ACCUs, and quite often this is state and territories using them to offset their own operations. But I wouldn't read too much into the fact that we didn't get any from the quarter, because it does jump around quite a lot. And Shalks asked about the 28.4%. Does this include Safeguard? So Shalk, you might just need to specify a bit more the 28.4%. ACCU demand, okay. So that should include a very small component of Safeguard. Safeguard doesn't represent a very high percentage of the total ACCU demand figure. It's only in the hundreds of thousands over the last couple of years. So while it does make up a very small portion of it, it's not a big shifter either way. Great. All right, we might shift then to our last couple of little sections. We're nearly through. Again, happy to have questions at the end, or anything you might want to hear more about. I can kind of extrapolate on or go back to. Right, so this quarter we did a market spotlight. on our small and mid-scale PV. This is the second year we've done this, where we try and do a mid-term outlook for small and mid-scale solar PV. Now, this isn't the modelling that we use to set the STP, the small scale technology percentage, which is the target that everyone has to meet next year for their small scale scheme. But it does provide a bit of an outlook for people to try and work out where that might be headed, and it also allows us to kind of keep people up to date on the rapid pace of the small scale installation story. And if you've seen some of the charts that we've published in previous quarterly reports, the small scale installed capacity has been rising by about 40% year on year for the last 4 years. So the growth has been quite phenomenal. And when we actually look at the small scale result for this year, for this quarter 3, 750 megawatts, which is more than all of what we had in 2016 in just one quarter. So the growth has been quite phenomenal. And one of the reasons that we do this work is to try and keep people up to date with the pace of that and what might happen next. So small and mid-scale modelling. So we actually approached 3 modellers this time around, GEMS, Jacobs and GHD. And we asked them to actually model for us and work with us on both the 0 to 100 kilowatt space, that's the SRES, the small scale scheme, and 100 kilowatt to 30 megawatt, which is the bottom end of the large scale scheme, to try and give us some expectations about where we're headed over the next couple of years, and obviously how fast we might transition. The big kind of headline from this work is that the overall result suggests that we're going to get, we think, out of this modelling result, 13 gigawatts of additional installed capacity. And for comparison, to date, we've only installed 13 gigawatts. So we're looking at doubling capacity over the next 4 years based on this modelling, which is a quite substantial contribution to renewable energy emissions reduction, and kind of signals quite a fast transition in the small scale. And when you combine that with the large scale committed pipeline that we showed earlier, we remain on the kind of pace that we've had for the last couple of years in terms of transitioning our electricity sector. So we have worked very closely with these modellers, because one of the things that we note is that modelling in this space has been off quite a lot, and there's no doubt, I'm sure, as more data comes in, this modelling will start to move out of date as well. But overall, over the last couple of years, in particular, some of our modelling, but also externally, people keep pointing downwards and the growth keeps happening. So we're trying to work with our modellers to find new ways of doing that, and use new techniques to try and counter that I suppose modelling incorrectness. So looking at some of the results, so I've just published the overall results here. You can go into the report and you can actually go on our website to read those reports in full if you're interested in the detailed dynamics and how they come up with their results. But overall, we have two models out of the 3 pointing upwards over the next couple of years, and one with a slight moderation. And even if you compare with the modelling that we did to set the small scale technology percentage in January, we're already up about 500 megawatts each year looking outwards. So we're looking at over 3 gigawatts on rooftops each year between now and 2024, which is quite substantial. But it is important to note that we take the midpoint, and the midpoint would suggest that there's a moderation coming in installed capacity. Perhaps we can't grow as fast as we have in recent years. In the mid-scale, that's where I think people are really still struggling to understand how much might happen in this space. There's some quite diverse views from our modellers in relation to this. Some think there's a very strong short-term horizon, but not so much in the long term, and some think the reverse. So I think this is quite reflective of the maturity of the space. The mid-scale sector has not had the predictability and the kind of steadiness of either the commercial kind of utility scale stuff or the rooftop space. This bit in the middle is still a bit unpredictable, but the midpoint in the modeller's results kind of floats around that 250 megawatts a year between now and 2024, which is still quite substantial growth, and reflective of what we saw in 2019 and probably what we're going to see in 2020. Stop there for any more questions. Okay, and we'll just jump to our last slide here. I do have a question there, so I missed that from Anonymous before about methodologies that lock in co-benefits and the Land Restoration Fund. Look, in relation to the Emissions Reduction Fund and the methods under that, it is structured around measuring carbon. Certainly when it comes to the LRF and the purchasing of the co-benefits that come along with that, there are methodologies underway for that. But under the ERF, we don't have a way of kind of certifying or measuring those co-benefits. There are, I know, a number of attempts and bodies trying to do that right now, though. I will say, though, that you know, in the QCMR, I don't have the chart with me now, but there is a clear trend towards savanna burning as the preferred supplier of voluntary carbon units, voluntary ACCUs. They represent roughly 2/3 to 3/4 of all ACCUs used for voluntary purposes. So there is a strong bias towards those savanna burning projects, which we know are kind of linked with Indigenous employment, Indigenous community support, which a lot of companies seem to value over and above the carbon value itself. Just jumping now, so one of the other things that we do publish in the QCMR every quarter is our estimate of the effect of carbon markets, or at least the carbon markets administered by the Clean Energy Regulator, on emissions reduction across the country. And this goes back to when these schemes started and what their contribution is. We are tracking to 54 megatons of estimated emissions reduction, and that's represented by the generation and the carbon credits, the ACCUs that come out of both the Renewable Energy Target and the Emissions Reduction Fund, which is quite a solid result. And look forward to the next quarterly report where we're trying to estimate what the outcome will be at the end of 2021. But quite a solid result and continued growth in the kind of contribution in terms of emissions reduction from the Clean Energy Regulator's schemes, which is really great to see. That's the end of the preso. Thanks very much for your time. If you have a question about any of the stuff in here, any of the things in the quarterly report, or if you want to understand more about the Clean Energy Regulator's data and what's available, you can email that email on the screen there, markets@cleanenergyregulator.gov.au, and we'll try and do our best to help you out. I'm very happy to talk more about what's in the report or what you might want to see as well. So if you've got any ideas or suggestions, shoot them through. I'll just pause there just to see if there's any last questions that anybody wants to ask before we close off. Looks like we're good. So look, thank you very much for your time. I appreciate the fact that you've shown an interest in looking at our report, and again, look forward to the next one, which is going to be very interesting. It'll provide our backwards looking what happened in 2020. And I can kind of prelude that saying it's a very exciting report coming up. There's a very strong performance across the board, but you can see that from the data already 3/4 in, I imagine. But it's been a very exciting year in renewables and in carbon farming in particular. So look forward to that. I'll leave it there, but thanks again very much for your time. And shoot through your questions whenever you want, and we're happy to help you out. All right, thank you very much. Have a great day.